Okay, let's just dive right into this explainer because we are deconstructing what is, without a doubt, the most consequential liquidity event in modern financial history. We're talking about the upcoming June 12th, 2026 SpaceX IPO. I've been digging through this 277-page S-1 prospectus, and let me tell you, it completely rewrites the rules of public capital markets. I am so excited to unpack exactly what's hiding inside here. Right out of the gate, SpaceX is targeting a jaw-dropping valuation of between $1.75 and $2 trillion. Trillion with a T. They're looking to raise up to $80 billion in equity. To put that into perspective, that absolutely obliterates the previous global record, which was Saudi Aramco's $29.4 billion debut back in 2019. This IPO instantly vaults SpaceX into the ultra-rare tier of the world's most valuable tech conglomerates, literally on day one. But here is where things get really fascinating. There is a massive, glaring contradiction lying right at the heart of their financials. On one hand, you have explosive growth. We're talking $18.67 billion in consolidated revenue for 2025, up 33% year over year. Awesome, right? Yet that sits right next to a staggering $4.94 billion GAAP net loss. They completely reversed their profit from the year before, and that sets up the central mystery we're going to solve in this explainer. Where on earth is all that cash actually going? Well, to make sense of this massive prospectus, we're going to systematically peel back the layers. First, we'll look at the biggest IPO in history. Then, Starlink, the cash engine. Next, their secret AI pivot. After that, the hyperscaler masterstroke. And we'll wrap up with the governance and planetary risks. All right, jumping right into section 1, the biggest IPO in history. You know, when we compare SpaceX's 2025 financials to the historical IPOs of legacy tech giants, the contrast is it's wild. Think about it. NVIDIA went public in 1999 with a very modest $93 million in revenue. Google debuted in 2004 with $1.35 billion. Now here comes SpaceX, hitting the market with nearly $19 billion in revenue, but they're asking for a valuation multiple of roughly 95 to 116 times that trailing revenue. That is astronomical. It tells us right away that traditional valuation metrics and your standard earnings yield analyses, they completely fail here. And looking at their revenue breakdown perfectly illustrates exactly why those old metrics don't work. They assume SpaceX is just a rocket company. But actually, scratch that. Look at these numbers. Right now, SpaceX is not primarily an aerospace manufacturer. It is fundamentally a global telecommunications company. 61% of their revenue comes directly from Starlink. Space operations, the actual rockets, make up only 22%, basically operating as a strategic loss leader. The company shooting rockets into the cosmos is actually paying for it with the Wi-Fi you use at your remote cabin. Which leads us perfectly into section 2, Starlink, the cash engine. By the first quarter of 2026, the Starlink network exploded to 10.3 million active subscribers spread across 164 countries. To pull that off, they're operating roughly 9,600 satellites in orbit. Let that sink in for a second. That is 75% of all active satellites in human history, owned by one company. Unsurprisingly, this division generated a highly profitable $7.17 billion in adjusted EBITDA for 2025. That's a massive 63% margin. Now, here is where it gets incredibly aggressive. They are not stopping at rural broadband. The S-1 reveals they're rapidly pivoting to direct-to-cell technology. They leveraged a massive $17 billion spectrum purchase from EchoStar, and now SpaceX is building 5G-like mobile satellites to connect directly to unmodified smartphones. They're transforming from a simple coverage extension partner into a massive wholesale network layer. This means your regular smartphone could soon connect directly to a satellite in space, completely bypassing legacy cell towers from giants like AT&T and Verizon. Moving on to section 3, the secret AI pivot. Now, here is the twist. If Starlink is such a massive, highly profitable engine, how did the company manage to lose almost $5 billion last year? It's a genuine puzzle, right? How do you burn through billions in telecom profit so fast that you still end up deeply in the red on your balance sheet? The answer, which is buried deep in the prospectus, is a strategy called capital recycling. Basically, it's taking those robust software-like margins from a telecom network like Starlink and immediately funneling that cash into high-risk, high-reward R&D. Now sure, Some of this goes to the Starship rocketry program, which burned about $3 billion last year. But surprisingly, the vast majority is being poured into massive artificial intelligence hardware. And this builds into a truly terrifying cash burn. Just look at the acceleration here. They went from a $528 million loss in Q1 of 2025, jumped to a full year loss of nearly $5 billion, and then posted a shocking $4.28 billion loss in just the first quarter of 2026 alone. To keep the lights on and manage this liability profile ahead of the IPO, they actually had to secure a stringent $20 billion bridge loan that literally has to be repaid using the IPO proceeds. So what exactly caused that massive burn? Well, in February 2026, SpaceX executed an all-stock absorption of Elon Musk's xAI venture, which valued the combined enterprise at $1.25 trillion. Following that merger, SpaceX poured a staggering $12.7 billion into data centers and GPUs last year alone, and then another $7.7 billion in the first quarter of 2026. They are building these massive facilities, like the Colossus data center in Memphis, literally packing them with hundreds of thousands of state-of-the-art NVIDIA accelerators. All right, Section 4, the hyperscaler masterstroke. This brings us to the climax of the prospectus, and honestly, the most fascinating part of this whole explainer. How on earth does SpaceX plan to survive this colossal AI spending spree without going completely bankrupt? To offset this insane burn rate, SpaceX signed an unprecedented cloud services agreement. Anthropic, the company behind the Claude AI model, is going to pay SpaceX $1.25 billion per month. Let me repeat that. That is $15 billion annually, locked in all the way through May 2029, in exchange for access to the massive compute capacity inside those Colossus data centers. This single contract proves something huge. SpaceX has secretly morphed. They are no longer just buying compute power for their own rocket routing algorithms or their internal Grok model. Nope, they have officially morphed into a hyperscaler. They're leasing excess compute capacity to launch a direct, highly capitalized assault on Amazon Web Services and Google Cloud. That $15 billion a year functionally subsidizes their entire AI hardware expenditure. It is a completely brilliant strategic maneuver. Okay, finally, Section 5, governance and planetary risks. Look, stepping into this $1.75 trillion arena means navigating some serious complications. Institutional fiduciaries, including the comptrollers of New York and the CEO of CalPERS, are raising severe alarms. Through a super voting Class B share structure, Elon Musk will retain 85.1% of the voting control. This legally renders SpaceX a controlled company, which means it's totally exempt from standard independent board and oversight requirements. These fiduciaries neutrally observe that this is an unprecedented concentration of power for U.S. public markets. Furthermore, the company is facing some massive peripheral risks. We're talking everything from micro-level ecological issues, like scientific surveys showing a 54% decline in the local piping plover bird population near their Texas starbase, which triggered litigation and $633,000 in FAA fines, all the way to macro-level existential threats, like Kessler syndrome. That's the severe threat of orbital congestion and space collisions among its 9,600 Starlink satellites. Layer on top of that their geopolitical exclusion from massive markets like China and Russia. And, well, the friction is palpable. And this all culminates in what absolutely has to be the most extraordinary executive compensation plan ever filed. The board approved a grant of 200 million supervoting shares for the CEO, and it is completely untethered from standard quarterly profitability metrics. To vest, the company must hit a $7.5 trillion market cap and legally fulfill an actual science fiction milestone, successfully establishing a permanent Mars colony of 1 million people. Public market investors are quite literally being asked to underwrite a sci-fi novel, an interplanetary demographic strategy, just to vest the CEO's shares. So, as this June 12th IPO approaches, the data in this explainer leaves you with a really profound question to ponder. When you look at that $1.75 trillion price tag, are you really buying an aerospace stock? Or are you ready to invest in a multi-planetary, AI-driven narrative, betting on the definitive, yet incredibly risky, infrastructure asset of the 21st century? It's a fascinating paradigm shift, and it's one that will absolutely define financial markets for years to come.